Hey y'all, hey. Hey y'all, it's Shannon, the credit realtor Peyton of eXp Realty, and I help you become a homeowner by helping you manage your credit and your finances so that you can do it within a year. So, today's topic is going to be what makes a mortgage payment. You're probably like, Shannon, stop. A mortgage payment. It's all the same. No, it's not. It is not the same. There are different things that make up a mortgage payment. So your mortgage payment is going to be made up of different parts. Now, it is be mindful that you're going to make one payment to the mortgage company, okay? And then when the mortgage company gets it, they split it up. Your mortgage payment is going to be made up of principal, okay? Which is the amount of money that you're actually borrowing. So if you borrow $100,000, that's the amount that you borrowed, okay? And then you have your interest, which is how they tell you, okay, 3.5, 4.5, 2.9, that. So they get that basically by doing a calculation if I use a mortgage payment. And when you send your mortgage payment to the mortgage company, you might notice on your statement that there's going to be different things that are broken down. So you'll see something that will say mortgage insurance, you'll see principal, you'll see interest, you'll see taxes, and other insurance, which is going to be homeowner insurance, okay? So once a year, when you make your payment for your mortgage, what they do is they split it up and they, send some to principal, they put some in interest, they put some in your mortgage insurance or send it to the account that holds your mortgage insurance. They send some to the account that holds your homeowner's insurance, and they send some to the account that holds your taxes. So you guys can see this. Principal, that's the amount that you borrow. This is the interest. Interest, remember, interest is going to be what you pay, the cost of borrowing money, okay? You have taxes. Taxes are going to be your city or county taxes. If you live in a township or if you see a sign that says within the corporate limits of, that's typically considered in town. When you live in town, that means that you're going to pay town taxes plus county taxes. Okay, so where I live, taxes cost a little more to live in town, but in exchange, it covers things like the police, pension, leaf pickup, pension, salaries, pensions. I think you guys get it, okay? And then you're going to have county tax, which is going to be the taxes that fall outside of a municipality or outside of the corporate limits of, okay? And then you have your insurances. Now, your insurances are going to be broken up, okay? You're going to have homeowner's insurance. You're going to have mortgage insurance. Homeowner's insurance is the insurance that covers you if something happens to your home. Acts of God. It does not typically cover flood. You're going to have to ask for an extra rider or an additional coverage for flood insurance. Okay, and you're going to have mortgage insurance. What mortgage insurance does is mortgage insurance says, hey, this is the premium that you're going to pay because we're loaning you money. And in the event that you default enough, or if you default, then, whoever is backing your loan, whether it be FHA, USDA, VA, that's government loan, or Fannie or Freddie Mac, okay, because that's on the back end, okay, if something happens, then this mortgage insurance is going to kick in and it's going to cover your non-payment. Assessments are going to be things like HOA. Assessments are not going to go in with your mortgage payment, but when your lender is qualifying you, they consider it, okay, as a part of the payment because it's something that you have to pay to live within where you stay. Which is why some people are like, I don't really want an HOA. Actually, I have never heard a person say that they didn't want an HOA because they had to pay for it. Very rarely. I always get people who say, I don't want to do an HOA because they're going to restrict what I want to do. Here I am more concerned about paying more money. But, to each his own. So that's what makes up a mortgage payment. So just be mindful that when you're paying your mortgage payment, you are going to have your mortgage payment and a part of it's going to be sent to escrow, which escrow is where they hold your payments for your taxes and insurance. And then they mail that out once a year. Okay, so even though when you become a homeowner, they're going to mail you like your tax liability, they're going to mail you your homeowner's insurance policy, tell you if there's been any changes because there's been like a hurricane and you might not even been in the area that it was, but it can affect your premium. They're going to send you all these things, okay? And you don't have to pay them because they're being paid into an escrow, and that escrow is being paid into when you make your mortgage payment. So it's essential that you make your mortgage payment, that you make it on time, and that you make it for the amount that they say, okay? So let me know where you guys are at. Did you know what made up a mortgage payment? Are you one of those people who's like, I don't want an HOA, but not because of the amount of it, but because you don't want to be told what to do? I don't blame you. I feel it, but all HOAs aren't bad. I want to thank you for your time. Thank you for joining me today, Shannon, the credit realtor Payton of eXp Realty in Delaware. I help you become a homeowner by teaching you how to manage your credit and finances and discussing all things in between. So thank you for joining me today, and you guys have a good one.